Welcome to Introductory of Business. I'm your professor, Dr. Mark Smith, and I'm looking forward to walking you through this introduction into business and welcome to Business 200. I wanted to go over specifically what is business, which is the practice of making a living by engaging in commerce, and of course commerce is the activity of buying and selling goods, services. Welcome to Business 200. I'm your professor, Dr. Mark Smith. I'm looking forward to introducing you to the overall business and entrepreneurship spirit of this course, and wanted to invite you to enjoy. This will be the first lecture of many that we will be going over specific businesses, aspects, and entrepreneurship as far as building a business from start to finish. But first things first, I want to introduce you to business with this rudimentary introduction. So, of course, what is business? Business, of its simplicity, is the practice of making a living by engaging in specific commerce. Now, when you break down what commerce specifically is, it's an activity of buying and selling goods and services, which originated from a barter type system and now has got more sophisticated with the monetary system that you know and economic structure that you know today. Now, specifically entrepreneurship, which this course is going to emphasize on, a person, specifically entrepreneur, is a person that organizes and operates a business or businesses. Essentially, they're the ones that gets everything started. It involves a significant amount of financial risk and personal risk as well when coming into grips with becoming an entrepreneur. Now, the first things I want to start with is creating a product and service. So when you're thinking about a specific business or service or product that you're going to be offering the public, you need to fulfill a certain amount of needs and understanding of what your public and society is going to want. So a good start is simply asking these few questions, like what need are you fulfilling with your product or service? Is there something out there you're looking to do? What's the market climate? Is this something that's thriving? Is it more of a niche market where it's going to be a more specific audience that you're targeting? Who's going to buy this? As far as who's your customer base? Like who are the people that you're going to be aiming towards? Like why is it important to them? And of course, the last but not least, how much is this going to cost? Are you going for like a higher end based product, similar to how Apple does their stuff? Or are you looking at more lower end cost cutting as far as getting your product in the hands of many people as opposed to just focusing on the few? These are specific questions you can utilize to help you gear down and understand a specific product or service and what you're going to be doing. So first things I like to do is do a couple just introductory to economics and markets. So the first video I'm going to preview is this nice fun little attribute here. Bear with me as it comes up.
60-second adventures in economics. Number 1, the invisible hand. An economy is a tricky thing to control, and governments are always trying to figure out how to do it. Back in 1776, economist Adam Smith shocked everyone by saying that what governments should actually do is just leave people alone to buy and sell freely among themselves. He suggested that if they just leave self-interested traders to compete with one another, markets are guided to positive outcomes as if by an invisible hand. If someone charges less than you, customers will buy from them instead, so you have to lower the price or offer something better. Whenever enough people demand something, they will be supplied by the market, like spoilt children, only in this case everyone's happy. Later free marketeers, like Austrian economist Friedrich Hayek, argued that this hands-off approach actually works better than any kind of central plan. But the problem is economies can take a long time to reach their equilibrium and may even stall along the way. And in the meantime, people can get a little frustrated, which is why governments usually end up taking things into their own more visible hands instead. Number 2, the paradox of thrift. Much like a child getting his pocket money, one of the biggest economic questions is still whether it's better to save or spend. Free marketeers like Hayek and Milton Friedman say that even in difficult times, it's best to be thrifty and save. Banks then channel the savings into investment in new plants, skills and techniques that let us produce more. And even if this new technology destroys jobs, wages will drop and businesses hire more people. So unemployment falls again. Simple, at least in the long run. But then a live fast, die young kind of chap called John Maynard Keynes cheerfully pointed out that, in the long run, we're all dead. So to avoid the misery of unemployment, the government should instead spend money to create jobs. Whereas if the government tightens its belt when people and businesses are doing the same, less is spent, so unemployment gets even worse. That is the paradox of thrift. So instead they should spend now and tax later when everyone's happy to pay. Though making people happy to pay tax was something even Keynes didn't solve. Number 3, the Phillips curve. Bill Phillips was a crocodile hunter and economist from New Zealand who spotted that when employment levels are high, wages rise faster. People have more money to spend, so prices go up and so does inflation. And likewise, when unemployment is high, the lack of money to spend means that inflation goes down. This became known as the Phillips curve. Governments even set policy by the curve, tolerating the inflation when they spent extra money creating jobs. But they forgot that the workers could also see the effects of the curve. So when unemployment went down, they expected inflation and demanded higher wages, causing unemployment to go back up, while inflation remained high, which is what happened in the 1970s, when both inflation and unemployment rose. Then in the 90s, unemployment dropped while inflation stayed low, which all rather took the bend out of Phillips's curve. But at least part of Phillips's troublesome trade-off lives on. When faster growth and full employment return, you can bet inflation will be along to spoil the party. Number 4. The principle of comparative advantage. Whether you think economies work best if they're left alone or that governments need to do something to get them working, the one thing that can't be controlled is the rest of the world. Fear of foreign competition once led countries to try and produce everything they needed and impose heavy taxes to keep out foreign goods. However, economist David Ricardo showed that international trade could actually make everyone better off, bringing in one of the first great economic models. He pointed out that even if a country can produce pretty much everything at the lowest possible cost, with what economists call an absolute advantage, it's still better to focus on the products it can make most efficiently, that sacrifice the least amount of other goods, and let the rest of the world do the same. By specializing, they can then export these surpluses to each other and both end up better off. This is the principle of comparative advantage, and it has persuaded many countries to sign up to free trade agreements. But unfortunately, it can take a long time for countries to trade their way to prosperity. And because it's now much easier to move to where the money is, it's increasingly not only goods that cross borders, but people, which has somewhat uprooted Ricardo's theory. Number 5. The impossible trinity. Most countries trade with one another, which is usually pretty good for all involved. But it does mean it's a bit harder for each to keep control of its own finances. There are 3 things that governments are particularly keen on. They like to keep the exchange rate stable so that import and export prices don't suddenly jump around. They also like to control interest rates so they can keep borrowers happy without upsetting savers. And they like to let money flow in and out of their country without causing too much disruption. But there's a problem when you try to do all of these at once. Say, for example, the Eurozone tries to lower its interest rate and reduce unemployment. Money flows out to earn higher interest rates elsewhere. Exchange rates drop, which causes inflation, so the euro interest rate is forced back up again. You can either fix your exchange rate and let money flow freely across national borders, but have no control over your interest rates, or control your interest and exchange rates, but then you can't stop the capital flowing in and out. But like an overzealous triathlete, you can't do all 3 at once. Number 6. Rational choice theory. Of all the things to factor in when running an economy, the most troublesome is people. Now, by and large, humans are a rational lot. When the price of something rises, people will supply more of it and buy less of it. If they expect inflation to go up, people will usually ask for higher wages, though they might not get them. And if they can see interest or exchange rates falling in one country, people with lots of money there will try to move it out faster than you can say double dip. And governments often decide their economic policies assuming such rational actions, which would be great if it weren't for the fact that those pesky humans don't always do what's best for them. Sometimes they mistakenly think they know all the facts, or maybe the facts are just too complicated. And sometimes people just decide to follow the crowd, relying on others to know what they're doing. When too many cheap mortgages were being sold in 2007, a lot of people didn't know what was going on, and a lot of others just followed the crowd. Some lenders may have rationally believed that when the crunch came, the scale of the problem would force governments to rescue them, which was true for the banks, if not for all their customers.
And that's that. And I'd really like to showcase that specifically to show that economics is not a sound science. It's a bunch of analysis and the idea of how to, I guess, monitor an economy and keep it growing at steadily pace and working out. They have not gotten it right. They still haven't. There's still quirks in it and there's still changes. So it's an ever-learning process. Just wanted to display that because if anyone ever was to say that they know exactly how it works and that they can prove it, they're definitely wrong. But then the next thing I like to always touch on for an introduction to economic markets is the currency itself, which is the money is worth. So I have another video for this as well, just to make it a little bit easier.
Let's suppose that you're writing a really important email to a colleague, or a post.
My apologies about the ad, but here we go.
If you tried to pay for something with a piece of paper, you might run into some trouble. Unless, of course, the piece of paper was a $100 bill. But what is it that makes that bill so much more interesting and valuable than other pieces of paper? After all, there's not much you can do with it. You can't eat it. You can't build things with it, and burning it is actually illegal. So what's the big deal? Of course, you probably know the answer. A $100 bill is printed by the government and designated as official currency, while other pieces of paper are not. But that's just what makes them legal. What makes a $100 bill valuable, on the other hand, is how many or few of them are around. Throughout history, most currency, including the US dollar, was linked to valuable commodities, and the amount of it in circulation depended on a government's gold or silver reserves. But after the US abolished the system in 1971, the dollar became what is known as fiat money, meaning not linked to any external resource, but relying instead solely on government policy to decide how much currency to print. So which branch of our government sets this policy? The executive, the legislative, or the judicial? The surprising answer is none of the above. In fact, monetary policy is set by an independent Federal Reserve System, or the Fed, made up of 12 regional banks in major cities around the country. Its Board of Governors, which is appointed by the President and confirmed by the Senate, reports to Congress, and all of the Fed's profit goes into the U.S. Treasury. But to keep the Fed from being influenced by the day-to-day vicissitudes of politics, it is not under the direct control of any branch of government. So why doesn't the Fed just decide to print infinite $100 bills to make everyone happy and rich? Well, because then the bills wouldn't be worth anything. Think about the purpose of currency, which is to be exchanged for goods and services. If the total amount of currency in circulation increases faster than the total value of goods and services in the economy, then each individual piece will be able to buy a smaller portion of those things than before. This is called inflation. On the other hand, if the money supply remains the same while more goods and services are produced, each dollar's value would increase in a process known as deflation. So which is worse? Too much inflation means that the money in your wallet today will be worth less tomorrow, making you want to spend it right away. So while this would stimulate business, it would also encourage overconsumption or hoarding commodities like food and fuel, raising their prices and leading to consumer shortages and even more inflation. But deflation would make people want to hold on to their money, and a decrease in consumer spending would reduce business profits, leading to more unemployment and a further decrease in spending, causing the economy to keep shrinking. So most economists believe that while too much of either is dangerous, a small, consistent amount of inflation is necessary to encourage economic growth. The Fed uses vast amount of economic data to determine how much currency should be in circulation, including previous rates of inflation, international trends, and the unemployment rate. Like in the story of Goldilocks, they need to get the numbers just right in order to stimulate growth and keep people employed without letting inflation reach disruptive levels. The Fed not only determines how much that paper in your wallet is worth, but also your chances of getting or keeping the job where you earn it.
Thanks for watching that, and that's just giving you an idea of the currency and how we pretty much prop up the money, because it's not really backed by anything besides our personal opinion and preference. And that just gives you kind of a background of the currency structure and how the economic makeup of the world kind of plays into each other. And now that we've become a more global economy, along with a very, I guess, every organization can become international very easily, all these things play into effect pretty easily. Now, the last thing I'd like to touch on too is understanding stocks and shares. The financial sector is a huge conglomerate of different entities that do various things in the financial markets. It's all the stock exchange, bonds, savings accounts, et cetera, et cetera. So I just want to give you a basic rudimentary understanding of that concept, as well as far as taking a company public and selling stocks and shares, as simple as I can do it. I apologize. Well, I don't apologize. The video is kind of dated, which I liked about it. So
I don't even know what they are.
Mm-hmm. You
In that case, it might be a good idea to get a little information with a fellow who owns and operates a company that makes and sells oil drums. Each year, customers buy more and more from our because he makes a better oil drum than his competitors. One day, customers demand more oil drums than the owner can produce. He figures it will take about $3 million to do the job. So he decides to form a corporation to sell shares in his business to raise the capital he needs. First, the owner goes to the state government to get a corporation charter and permit to sell shares in this business. Next, our friend goes to an investment banker and shows him the record of the oil drum manufacturing company's past performance and plans for expansion. The investment banker decides to help our friend sell shares in the corporation to raise the $3 million. However, before any shares in the corporation can be sold, certain information must be filed with the Securities and Exchange Commission in Washington. The investment banker and the owner must swear that the information they file contains nothing but the truth. Registration with the SEC does not imply that the government approves the stock issue as a good investment, but only assures the public the material statements about the stock issue are false. Punishment will be according to the law. After SEC registration is effective, the investment banker pays the owner $3 million in exchange for a certain number of shares in the Oil Drum Manufacturing Corporation. The investment banker sells shares of the common stock to people at a price of $3 million investment and shows a profit for his services in selling the stock. Money received from the sale of shares in the business builds a new and better plant, which produces more and better oil drums. The people who bought common stock own proportionate shares in the corporation, tools, equipment, and all of its assets. Stockholders elect the directors of the corporation. Directors represent the stock and are responsible for the way the business is run. Directors determine the amount of dividends, if any, to be paid out of earnings to the stockholders. Naturally, when stockholders invest in a business, they hope to receive dividends to help pay for necessities of life. Within a few short years, an increasing demand for the company's product poses a friend. How can he fill all the orders? He will have to build more plants and buy more tools to increase production of oil drums. It will take about $20 million to do the job. One way to get this additional capital is to sell more stock to many more people. So the Oil Drum Manufacturing Corporation votes to send its president to the New York Stock Exchange to see if their common stock can qualify for listing. The corporation wants to list its securities on the exchange so that the additional stock they need to sell will be more attractive to investors all over the nation. Securities listed on the New York Stock Exchange can be sold for cash any time in this national marketplace.
Each year, inquire about listing their securities, but only those which can pass a thorough examination as to their financial health are accepted.
Calling the president of the Oil Drum Manufacturing Corporation. Calling the president of the Oil Drum Manufacturing Corporation. Report to Examination Room B. Attention all members of the Stock List Department. Report to Examination Room B.
The Stock List Department examines the qualifications of corporations to be listed on the New York Stock Exchange. The corporation must have substantial assets in plants, tools, equipment, and cash. There must be a broad distribution of its shares among a large number of stockholders. The corporation must show successful management and sales records and annual net earnings at the time of listing of at least $1 million. The proposed stock issue must meet federal, state, and New York Stock Exchange regulations. The corporation must agree to report to its stockholders at frequent intervals. If the examination by the Stock List Department indicates the corporation meets minimum requirements of the exchange at the time of the examination, The corporation's application for listing is recommended. The Board of Governors of the New York Stock Exchange finally approves the application and sees that it is made public.
Extra, extra, read all about it.
Now that the Oil Drum Manufacturing Corporation's stock is listed, its name is abbreviated for use on the ticker tape. Each time ODM stock or any other stock listed on the exchange is bought or sold, the ticker tape flashes all over the nation the price and number of shares traded. A buyer in Colorado wants to purchase some ODM stock. The buyer's broker in Colorado sees that the last ODM transaction was at $10 a share. The buyer could buy from 1 to 99 shares, which would be known as an odd lot. But a Colorado friend decides to invest in 100 shares, known as a round lot. The Colorado broker wires the order to his New York office. The buy order is telephoned to the floor of the New York Stock Exchange. It is given to the firm's floor partner, who becomes the representative of the buyer in Colorado. The floor partner goes to the post where ODM stock is traded. The representative of the buyer in Colorado bids $10 a share for 100 shares. But at the moment, there is no stock offered for sale at this price. In the meantime, however, in Maine, an ODM stockholder who needs cash decides to sell his 100 shares if he gets $10 a share. The Maine broker wires the sell order to his firm's representative on the floor of the New York Stock Exchange. This firm's floor partner, representing the seller in Maine, offers to sell 100 shares of ODM stock at $10 a share. The price of $10 a share is mutually acceptable and the transaction is made. Like the cowboy in Colorado and the fisherman in Maine, investors all over the country use the facilities of brokers who are members of the New York Stock Exchange whenever they want to buy or sell stock of companies listed on this national market. Yesterday's savings financed the miraculous growth of our railroads.
Love that, but just wanted to give you a rudimentary understanding of selling stocks as far as the shares are concerned, and how to get on an exchange and how that works for a company and the due process for it. And that's just pretty much encompassed of a very brief introductory into business as a whole. That will conclude our discussion and lecture for today, and I look forward to sending out more of these as we progress through the class. Thank you for your time.